Hola, bienvenidos. Hoy es miércoles y 5 de mayo. Today we'll be talking about depreciation. In chapter 8, we'll be doing the multiple choice, and I'll spend a little time kind of doing some teaching on depreciation while we're doing the multiple choice. This is Tax 1, Chapter 8, multiple choice questions number 1 through 10, and we'll get started on that right away. So let's go to question 1. Alice purchases a rental house on June 22nd, 2020 for a cost of $174,000. Of this amount, $100,000 is considered to be allocable to the cost of the home, with the remaining $74,000 allocable to the cost of the land. What is Alice's maximum depreciation deduction for 2020 using MACRS? One of the realities of online instruction, well, actually online learning, it's more from your end than mine, is that a lot of the understanding comes from you. And so you have to spend, I think it's much harder to take an online course than a face-to-face course, because you have to sift through the book and determine what's important and what's not. This chapter is full of a lot of terms, a lot of new things that can make it very difficult. So hopefully this will help sort through some of that process. Tax 2, we spent a little more time in this in Tax 2. Tax 1, we have to spend a little bit of time in this because we do talk about the Schedule C in Chapter 3, which is small sole proprietor business, and so depreciation becomes part of that discussion. The one thing you should know, well, one of many things you need to know, is that there is a difference between the accounting version of depreciation and the income tax version of depreciation. So they are similar in the sense that they're both depreciation. They are dissimilar in the sense that the tax method is prescribed for us by the IRS, whereas the book method, we have more discretion. Anyway, in this case, this is real estate, and real estate depreciation is discussed, I believe, on page 8 of the chapter. I've got my office helper here. You may or may not know that I have an office cat, and she happens to be laying on the book, as cats will do. They love laying on the newspaper that you're trying to read or the book you're trying to use, and she's mildly irritated by the fact that I had to move her a bit. If you turn to page 8 of the chapter, and at the top of, well, in that page, you see two tables, tables 8.5, and it's a real estate depreciation, and it's residential and non-residential is broken up into two categories. This is a rental house, so it's going to be residential. And so we put it into service in June, so that'll be the 6th month. So we go over to the 6th month, and the first year, and there's a factor there, 1.97, which is a percentage. And so we have $100,000 is the cost of the house. And so we'll multiply that by 1.97%, which is $1,970, which is letter B. That's how the table works, and that's how you find the proper column to be in the month you put it into service. And notice what they did is that they had to split up the cost of that asset into two things: the cost of the building and the cost of the land. Land is non-depreciable. You cannot depreciate land. The cost of the land stays the cost of the land until you sell it. Now, you can do things to the land. You can put a parking lot on it. That part's depreciated. You can put a fence around it. That cost is depreciable. You can put lights on it. That cost is depreciable. You can put drain tile under it. That cost is depreciable. You can even get depreciation expense for some of the landscaping you do around it, like planting trees and things like that. Could be depreciable, depending. But the land itself is non-depreciable asset. So that's why it's important to break out that cost. And how do we do that? Well, usually by an appraisal or a tax bill. The real estate tax bill will break out the land value from the building value. So there are ways to get that allocation down. Now, what is our motivation here as accountants? Well, the motivation is to get the land value on our financial records to as low a number as we can, within reason and supportable by an appraisal or a real estate tax bill, and allocate more of as much of the cost as we can to the building, because we get some depreciable benefit out of that building cost. Okay, so anyway, number one, letter B. Number two, an asset, not an automobile. So, and that comes up in, I don't know, page 15 or so. Has a depreciable basis of $25,000 in a recovery period of 5 years. Assuming half-year convention, no bonus, no election to expense. What is the maximum amount of costs that can be deducted in 2020? Boy, do they cover a lot of ground in this one question. And so I need to spend some time on this one question. The depreciable basis is just the cost of the asset. If you've had accounting 1 or accounting 2, really in our class structure is where depreciation is discussed. The salvage value is discussed a lot there, and I'm here to tell you that very few businesses worry about salvage value. First of all, you can't use salvage value on your income tax calculations, and plus it's usually a small dollar amount unless you have cruise ships or railroad locomotives or something that has significant scrap value. Don't bother with salvage value whatsoever. It's very theoretical. So our depreciable basis here is, the book version is cost less salvage value is basis. Well, there is no salvage value for taxes. Recovery period, that is the useful life mostly in years, but it's useful life in our textbook. For taxes, they call it recovery period because it may or may not have any relationship to the actual life of the asset. And then half-year convention. What that means is that we're putting, regardless of when we buy the asset, let's say it's a piece of equipment, office furniture or something, regardless of when we put that piece of equipment in service, March, October, doesn't matter, we're going to take a half-year depreciation in year 1. Now that kind of goes against chapter 10 of the accounting textbook we use, where our partial year depreciation is based on the number of months that we put it in service, regardless. Again, that's the difference between accounting book depreciation and income tax depreciation. So tax depreciation, by and large, for anything that's not real estate, is going to use a half-year convention. And then what else did they talk about? Bonus. There's 2 other types of depreciation. Well, early or accelerated depreciation that the tax law allows us to use that helps incent small businesses to purchase equipment that they need, and they get a tax benefit right away. And the first one was Section 179 depreciation, which they refer to as election to expense. And then the second one is this bonus depreciation. Now, up until the Tax Cut and Jobs Act of 2017, there was a way that people would use both. They would use the bonus and the election to expense, and then finally regular depreciation. Well, the Tax Cut and Jobs Act of 17 kind of clarified all this. It did away with a lot of the limits on bonus, and it also did away with a lot of the limits on Section 179, practical limits, and so the major difference left behind was one of the limitations for Section 179 depreciation is that that Section 179 cannot result in a business loss. So that's one of the limits. Well, bonus doesn't have that limit. So what everybody's been doing since the Tax Cut and Jobs Act of 17, which really took effect in 2018, is bonus depreciate everything. So that bonus depreciation is really 100% depreciation year 1 for practically every small business in the country. So when they say here, and then bonus is considered to apply unless we specifically elect out of it. You have to tell the IRS that you're not using bonus. Otherwise, they'll assume that you're using bonus. So anyway, so we've got the half-year convention, no bonus. So they elect it out, and they're not going to use the Section 179 election to expense. So what's left is just garden variety modified accelerated cost recovery depreciation, MACRS. And so they had to say all that just to get to that thing, that we're just going to use the MACRS tables, no other fancy stuff. So that table is on page 8-4, bottom of the page. Accelerated depreciation for personal property. And if you haven't taken your law class yet, there's two types of property involved. There's real property and personal property. Personal property is not what I own personally. It's personal property is anything that's not real property. Real property doesn't mean it actually exists. It's real versus fake or whatever. Real property is land and buildings, real estate. So it's land and buildings is real property. Personal property is used, and this is a legal term, personal property, and so that's why I mentioned if you've taken your law course yet. Personal property is anything that's not real property. Vehicles, equipment, furniture, whatever. That's all referred to as personal property. And personal does not mean that you or I own it personally. It's just a legal term. Get used to it. So if we use this table, accelerated depreciation for personal property, assuming half-year convention, and so we'll go to the 5-year column, 1-year row, and that's 20%. So we'll take 20% of the purchase of the basis. So it's $25,000 multiplied by 20%, which is letter B, $5,000. There's a lot of learning in this simple question. So first of all, we need to know what is basis, what is the recovery period, what is half-year convention, what is bonus, what is Section 179, or in this case, they call it election to expense. And so we have to kind of define all those things before we get to the fact that, oh, they just want us to use the table on page 4. Okay, that's number 2. Number 3, an asset, not an automobile again, that comes up later. Put in service in June of 2020, has a depreciable basis of $28,000 and a recovery period of 5 years. Assuming bonus depreciation is used, half-year convention and no election to expenses made, what is the maximum cost of amount of costs that can be deducted in 2020? Bonus is talked about on page 7. So let's back up and take a look at page 7. And again, a lot of these changes are due to the Tax Cut and Jobs Act of 17. But if you just take a look at this, increase the depreciation percentage to 100% for qualifying property acquired and placed in service after September 27 of 17 through December 31 of 22. Now, a lot of the tax law changes that have happened since, gosh, I'm thinking, President Clinton on up, have been referred to in the law as temporary. And I'm pretty sure that that's just a way to get other people, whoever's in charge of the White House, to get other people on the other side of the aisle to vote yes for it, so they can go back to their home state and have people say, well, you voted for a Republican or a Democrat tax law changes. Yeah, but only because it's temporary. So most of the Tax Cut and Jobs Act was temporary. The only one thing that was considered permanent, and we'll find out how permanent that is in a few months, was the 21% flat tax rate for corporations. Now that's built in already in the proposed infrastructure bill in front of the House and Senate, that the plan is to raise that flat tax for corporations up to, I think, 28%. So it wasn't very permanent. So, and of course, none of it is. Anyway, so if we take a look at that, we can take 100% of the qualified property in year 1. Now, this bonus starts to phase out. And we see that in the next section here, that it starts to phase into lower rates. And we'll see who has the White House in 24, or better yet, who has Congress and the Senate in 22. Who knows? All I know is it's been a very interesting political time since 2016. But anyway, so taking a look at this one, that if we see that bonus is 100%, and she purchased an asset costing $28,000. 100% of $28,000 is $28,000, letter D. So you can see how beneficial this is to small business, and that if they buy an asset, they can expense it right away in year one. And it drastically lowers their tax bill for that year. Now, what happens next year? Well, it goes back up. But in the year they buy the asset, they get a pretty good shot in the arm. Is this right? Is this fair? Is this unethical? It's the law. Now, if you ask me personally, whatever we can do to help small business survive is okay with me. Because small business is truly the engine that drives the economy of the United States. You know, it's not Amazon, it's not Tesla, it's mom and pop stores around the corner. So let's make it easy for them. Next question, number 4. James purchased office equipment for his business. The equipment has a depreciable basis of $14,000, was placed in service on June 1st. James decided to elect straight line depreciation under MACRS for assets over the minimum number of 7 years, and he elects out a bonus, does not elect to use Section 179. So just garden variety stuff. Like I said, everybody uses bonus now. So the textbook must have had a hard time coming up with, how do we teach all this stuff when we know that the strategy is to use bonus? Well, okay. Well, the straight line tables are on page 5, I think. So let's turn back to page 5. And table 8.3 is straight line depreciation for personal property. And if you go to the 7-year column, or sorry, the first recovery year column, 7-year row, it's 7.14%. So if we take $14,000 multiplied by 7.14%, and you get $999.60. Well, that's close enough to $1,000. So letter B. And again, you find that on page 8-5, table 8.3, first year column, 7-year row. All right, number 5, which of the following statements with respect to depreciation of property under MACRS is incorrect? These always bug me. The one where we're looking for the wrong answer, but it also helps me because they have a lot of true statements that we can use a lot of teaching moments on. So letter A, under the half-year convention, 1 half-year of depreciation is allowed in the year the property is placed in service. That's a true statement. Half-year convention means we take a half-year depreciation regardless of when you put it in service in the first year. Letter B, if a taxpayer elects to use straight-line method of depreciation for property in the 5-year class, all other 5-year class property acquired during that year must also be depreciated using the straight-line method. That's also true, that if you elect straight line for anything in any particular year, everything you buy in that year has to be straight line. Now, what about next year? Next year is next year. You make the choice again. Now, you know, in the tax returns I prepare, I never see anybody electing straight line. So that doesn't mean that it doesn't happen. But anyway, that is a rule. Letter B is a true statement. Number C, in some cases, when a taxpayer places a significant amount of property in service during the last quarter of the year, and if we use a calendar year, that would be October, November, December is the last quarter of the year, real property must be depreciated using the mid-quarter convention. And the mid-quarter convention is discussed on page 8-5 and 8-6. And if you turn to page 8-6 and you take a look at the mid-quarter convention table and just read the title, Accelerated Depreciation for Personal Property Assuming Mid-Quarter Convention. Well, this textbook is famous for throwing a quick pitch in the dirt and making a question hinge on 1 or 2 words. The 1 or 2 words in this particular one is real property. Mid-quarter convention does not apply to real property. It applies to what? Personal property on table 8.4. So that makes this the outlier. This is an incorrect statement just because they use real property versus personal property. So let's continue the teaching on this and take a look at letters D and E as to why they are true statements. Real property acquired after 1986 must be depreciated using the straight line method. It is depreciated using the straight line method. There are tables for that though. And those tables are, where are they? On page 8.8 or 8-8, This is straight line depreciation for real property. There is no accelerated depreciation for land and building, well, for buildings. So letter D is a true statement. Letter E, the cost of property to which MACRS rate is applied is not reduced for estimated salvage value. Also a true statement. Salvage value is not taken into consideration when calculating depreciation using the tax methods. All right, good question. Number 6, which of the following is true about the MACRS depreciation system? So which is true? Letter A, salvage value must be determined before, yeah, that doesn't work because we already know salvage value doesn't apply. Letter B, residential rental buildings are depreciated over 39 years straight line. Well, we're okay so far, where residential buildings are depreciated using straight line, but if you keep your finger on page 8-8 and you take a look at table 8.5, and the very first one is 27.5-year residential real property. So residential property is depreciated over 27.5 years, not 39. So that makes letter B incorrect. Letter C, commercial real estate buildings are depreciated over 27.5 years. Well, look down at the next table. 39-year non-residential, which would be commercial, non-residential real property. Again, they just flip-flopped those, made them both wrong. So that's the only problem with B and C. They just flip-flopped the true numbers. Letter D, no matter when during the month depreciable real estate is purchased, it is considered to have been placed in service at mid-month for MACRS depreciation purpose. And if you take a look at page 8-9, mid-month convention, that's how these percentages are built. If you take a look at the first year column or first year row for both of these tables, the first year row is based on mid-month. So if you put it in service on June 1st, the depreciation is calculated as though you put it in service on June 15th. So what? I mean, but it's just one of those things, mid-month convention. It is a true statement. So letter D for number 6. Number 7. On July 20, 2020, Kelly purchases office equipment at a cost of $24,000. Kelly elects out a bonus, but makes the election to expense for 2020. She is self-employed as an attorney, and in 2020, her business had a net income of $12,000. Evidently, she just started business, or she's not very good at it. Before considering this election to expense, Kelly has no other income or expense for the year. What is the maximum amount that Kelly may deduct for 2020 under the election to expense, assuming she elects to expense the entire $24,000 purchase? They're doing their best to try and lead you into the wrong answer. The election to expense discussion is on page 10. Is on page 10. There used to be dollar amount limits on this, and now they've got really 3 limitations on here, and they don't label them real well, but the 3 limitations are a maximum amount you can expense, the phase out depending on your income, and then the taxable income limit. And so the maximum that you can expense has increased substantially. So it has risen to a little over $1 million. So Kelly doesn't have that limit problem. She's only at 24,000. And then the next one down is the maximum expenses reduced when you're over the limit. So if you've purchased $2.6 million of equipment, you start losing how much you can expense. Well, she's way under that. And then the last one, the amount of acquired qualified property that may be expensed annually is limited to the taxpayer's taxable income before considering any amount expensed under Section 179. That's the one that applies. This is the paragraph right above the first example on page 8-10. The income limit applies here, so she can only take $12,000 as depreciation in the first year. Now, if you're her tax consultant here, why would you not just elect a bonus? I mean, not elect out. bonus is implied. You're going to get bonus unless you specifically check a box saying that you're not going to use bonus. So take the bonus, show a loss, and deduct the loss, carry it forward. Anyway, again, they're not talking tax strategy here. This is just various depreciation methods. And I think the book is trying to stand on both sides of the fence because they know that this is a political football. It changes quite often. So they don't want to just make huge changes to the text because perhaps next year, well, not next year, but perhaps in the very near future, a lot of these limitations are going to get thrown back in to Section 179 and to bonus depreciation because some people in Washington hate business. Anyway, that's number 7. Number 8, which of the following is not considered a limit on the immediate expensing election of Section 179? And if we walk through these, and I'll skip letter A because that it is the correct answer, but letter B says total Section 179 eligible property acquired in excess of $3,630,000. This is a limit. This is the second of the 3 that we just discussed. Letter on page 10. Letter C, the taxable income of a taxpayer considering all income and deductions except, yeah, that's the income limit. That's the one we just talked about in question 7. And then an annual limit, the annual maximum of 1.04 million. Well, that's also discussed, and that's the first one. Letter A, there is no 50% of qualified improvement property limit. So letter A is the best answer. Also found on page 10. Number 9. In 2020, Ben purchases and places in service. Now, this is the IRS and Congress got all mad at people about their business use of vehicles, and I don't know, in the mid 80s, and they're still evidently mad about it. So we've got a couple of questions based on cars. In 2020, Ben purchased and placed in service a new auto for his business. The auto cost $57,000 and will be used 60% for business. Assuming the half-year convention applies, Ben elects out of bonus and Section 179. What will depreciation on the auto be in 2020? I don't like the wording of that, but okay. If you take a look at page 8-15, limitation on depreciation of luxury automobiles. This has been just laughable for decades. That they're, if the CEO of, I don't care, Microsoft now wants to drive around in a Humvee and have the business pay for it, I don't care. It doesn't matter to me. If they want to buy a $300,000 Lamborghini and depreciate it on their tax bill and say it's a business car, I don't care. It doesn't matter to me. They're the CEO of Microsoft. I mean, so what? Anyway, this just seems punitive, mostly to small business, because they might want to have a nicer car that they call a business car, maybe use it 40 or 50% personally. Again, so what? Anyway, so there's depreciation limits. And if you take a look at the table 8-15 on page 815, there's an annual automobile depreciation limitations. And the first year, you can only take $18,100. Now, there's an asterisk there. Never overlook these asterisks or footnotes because there's something important they're trying to tell you. That asterisk says additional bonus depreciation of $8,000 is included in this amount. Well, in this case, Ben has opted out of bonus. So the maximum depreciation he could take would be the $18,100 minus the $8,000 of bonus he doesn't want to get to $10,100. Now that's if he uses it 100% for business use. He only uses it 60% for business use. So multiply that by 60%. Then his depreciation on the business use of that asset is $6,060, letter C. Letter C. Below that table is kind of fun. that it says here, some sport utility vehicles fall outside of the definition of passenger automobiles and can be depreciated or expensed under Section 179 or the bonus depreciation rules without regard to the automobile deduction limits. To qualify for the exception, the sport utility vehicle must have a gross vehicle weight rating of above 6,000 pounds. A few years ago, it was only 4,000 pounds. And so that's why you started seeing this rise in massive Lincolns and Cadillac SUVs. You know, the Navigator and the Escalade, even both of them made a pickup truck that was over 4,000 pounds, and high luxury, of course. And so you wondered who bought those? Business people did, so they could depreciate them all. So then what did Congress do? Raise the limit to 6,000 pounds, which makes it a truly massive vehicle. So who says that business people don't adapt? So if you're from Wisconsin and you've been around a little while, I mean, who was that guy, that attorney that drove around in the actual, the military version of the Humvee? He was kind of the only one in the state that was driving one for a while. I can't remember. He wore a cowboy hat. He was kind of an injury lawyer. I'll remember his name as soon as I stop recording. But his commercials were epic. Anyway, so number 9 is letter C, $6,060. Number 10 is very similar. It's just 100% business use. Ben purchases and places in service a new auto for his business. The auto costs $57,000 and will be used 100% for business, assuming the half-year convention applies, and Ben does not elect out a bonus. What will the depreciation on the auto be in 2020? Well, using that same table on page 815, $18,100, letter C. All right. This video was a little longer because I took some time to do a lot more instruction based on the questions. Hopefully this helped cleared up some of the questions involved with this chapter, because it just bombards you with massive amounts of detail. So if you can separate the things out, bonus, Section 179, ordinary MACRS, and then real estate versus personal property, then on real estate, you got 27.5 years for residential, 39 years for non-residential. On the personal property, you're usually going to be using 3, 5, and 7 years. 5 years is the big one. It covers almost everything, and then 7 years is 3 is a few things, 7 is a few things. Most of the stuff falls in 5 years. Listed property is the stuff that the luxury vehicles fall into. That's page 15. So always be careful if you see a business client add a vehicle to the depreciation list. Just take care to make sure to get the right depreciation number. You need to have them tell you what the business use is. And this is one of those things where there's preparer liability, that we have to go through some steps to make sure that the client knows that they have to keep a diary of their business use. It can be handwritten. Personally, I prefer it to be handwritten. And then, of course, use different colored ink and whatever, and keep the dates and keep it in the car as to document the business versus personal use of the car. If you refuse to use analog, if you want to use a digital diary for the business use of your car, go ahead. But you have to keep that to support the business use of the vehicle. Now, as a tax preparer, I never ask for it. You never would. Don't ever ask your client to see a copy of the diary, because once you see it, then you have to be responsible for it. All you have to do is tell them, ask them, you have a diary, right? And they'll say, yes. And you'll say, is it written? And they'll say, yes. That's all you need to do, is document that you asked and answered those questions. You don't need to look at it. I'd recommend not looking at it. Anyway, this is an important chapter, mostly in accounting, in tax 2, but it's good to know in tax 1. So hopefully this helped. Stay tuned for chapters 9 and 12.